Hello, and welcome to the Investors Round Table, a three-way discussion where Roland Head, Graham Neary, and myself, Mark Simpson, talk about shares, portfolios, and the markets. Roland likes reliable dividends, Graham likes quality compounders, while I look for deep value. This time we have a follow-up to a previously discussed stock, Airea, together with discussions on luxury goods company Burberry, FTSE 100 retailer Next, and a small cap publisher called National World. Let's get started. Hi guys, good to see you again.
Hi, Mark.
Hi, Mark.
It feels like it's been a busy time recently with a lot of results this week. One of the companies we discussed previously actually reported on the day we're recording here, and it's Ariea. I liked this company at the time. I thought there was a lot of potential for the stock to recover. It's a kind of old school carpet tile manufacturer that had gone through some changes, appears to have ditched a pension fund issue, and the new CFO, new CEO were looking for growth again. But you guys are a bit less convinced, weren't you? Roland, what did you think at the time?
Yeah, I think my main feeling was maybe it was a bit subscale compared to the kind of thing I'd normally look at. They seem to be investing quite a lot in adding new growth capacity, and it struck me that the amount being suggested
It's 5
about
million,
5
wasn't
million.
it?
Yeah, it seemed a big commitment for that company. I wasn't sure how much of a pipeline was really supporting that, but I didn't have a chance to have a close look at the results, but I guess you probably have done.
Yeah, I was a bit underwhelmed, to be honest. I changed my mind a bit on this one. So one of the big things for me was that the pension fund appeared to be solved. There was a time pre-COVID where it looked like all the money was going into this pension fund. And I don't think we've had the annual report yet, so we don't get to see the details of exactly what's happened. But this deficit has gone from fairly minimal with no recovery payments being made to them saying it's now due to weak asset performance, it's gone to a 5 million deficit. And this is a 14 million market cap company. So it's starting to look a bit of a problem. And they're also talking about discussion with the trustees to start making payments again. So this just, I don't know whether it's badly run or what it is about this pension deficit, but I treat these things like debt. So it's like the debt has gone up by an unexpected £4 million. To be fair, the cash has gone up. There's a decent cash balance here. This isn't a kind of existential risk to the company, but it does look like together with this big capital investment, pretty much all that cash is earmarked. And the EPS disappointed me a little bit as well. They've been increasing costs. This is one of the frustrating companies that don't reveal their gross margins. Several companies do it because they think it reveals too much of their competitive practices. I think Reynolds is another one that kind of stands out with this, but it makes it harder to model. And I'd assume that as they'd have growth, there'd be some operational gearing, whereas actually the operating margins have stayed pretty consistent. When it looked dirt cheap, then I was interested here. But I think the reality is this is a longer term growth story than I think from certainly these results seem to imply that. And I'm guessing sort of maybe 4p of somewhere around 12 or 14 when you adjust for these pension deficits. And you get a lot of value elsewhere for that sort of rating in the current markets, can't you? Graham, did you get a chance to look at these at all? Do you have any thoughts?
Yeah, I may have said this last time. I've had bad experiences with flooring companies in the past, especially in the micro cap space and the small cap space. It's very hard to find a flooring company that's got some amazing product that gives it a competitive advantage. I have looked at Aria's products on their website and they've got some registered trademarks, but I'm not totally sold on the idea that there's some amazing, unique product offering here. As for the company's financial performance, it's not bad by any means. It's still profitable. Return on equity seems okay with net assets of £15 million. And
that's probably the thing that is going for it, is that you are still getting a discount to that tangible book value. Yeah. I don't think it's without some good qualities, but as you point out, it's not standout anymore, is it really?
You know, it's generating a return on equity that seems okay. Pre-tax profits, £1.4 million each year on that net asset base of about £15 million. So it's doing okay, but I'm not sure what the selling point is for investors or for customers.
I think
it's okay.
You talk about flooring companies. I noticed that sort of both Headlam and Victoria Carpets, okay, they're slightly different businesses, but both struggling as well at the moment. So they are doing well in a difficult market, but
and you're taking quite a lot of economic risk in the sector. Isn't that one of the big issues?
Yeah, I think it's a risk on it's usually offices and commercial space, isn't it? So if offices and commercial space are struggling, then they're not going to be spending money on new carpets and flooring. The thing they have for going for them is they said they're kind of a bit more closely aligned to customers. So they've been doing some sort of voice of the customer stuff and making sure their products match what the customer wants. And it seems that some of the more ecologically minded products are selling pretty well as companies increasingly focus on that kind of ESG side. And I think that's why they're doing this big sort of 5 million investment into machinery as well, is it enables them to produce more of these products more economically. And I think there is a potential benefit to come. But as Roland pointed out, they don't have a big order book. Yeah, without a sort of long-term order book or anything behind that, this does seem quite a risky strategy. So I'm afraid I've changed my mind on this one a little bit.
Yeah, I don't blame you. Like, it's a small company, very small company, and with 1.4 million pounds pre-tax profit, compare that to 5 million pound investment that they're making, the 5 million pound pension deficit. As you say, they do have cash, but for such a small company, it's not even clear that these are safe investments that they're making, or that the pension deficit is going to be easy to pay off if that becomes necessary. I will point out, we'll give a Stockopedia plug here. The stock passes the Ben Graham Enterprising Investor screen, and that's a screen I always like to see. It's a deep value, but it's also a company that is profitable and that has paid a dividend, has some EPS growth over the long term. To pass that screen, it must have some attractive features, so I give it some credit.
I think it's an example. You do come across these, I think, small companies occasionally, and they look quite decent. They're profitable. They've been doing it for a long time, but then they're very small and you can't rely on the scale that you might rely on with other businesses where they're a well-known entity, well understood by the market. And so there's always that. I think it's a situation where a bit of extra research can be more rewarding than it might be in another place. And you come to understand the product and the market maybe a bit more than you would need to with a larger company. And this seems like an example of that. There doesn't seem to be anything you can really put your finger on that's wrong. And as you say, Graham, it's doing reasonably well and has done for a while. But then again, it's small, it's closely held, it's very illiquid. I guess there's not much coverage. So it's maybe more of a specialist thing for someone who's willing to put the time in.
Yeah, I'd possibly one for those who like to visit AGMs and talk to management and do the on-the-ground stuff. It sort of reminds me a bit of Tandem. I don't know if you've come across Tandem, bike distributor, and did very well in the pandemic and gained a bit of a following. But the recent results, understandably with consumer demand where it is for these sort of products, then yeah, they've been doing really quite badly and tipped them into loss making. It's another one that had results this week, I believe. It's another one with kind of property assets and some downside protection from that. But it seems that these property assets for Tandem are quite unproductive. They've invested in a lot of warehousing capacity based on the previous assumption, here are the boom times. And I think in the last trading statement, they said, oh, we're looking to an acquisition to basically fill the warehouse space, which is to me a tacit admission that they've overinvested. And that commitment seemed to have disappeared completely, or something. My skim read of the results didn't pick up that, which is also fairly obvious to anybody who can look at their balance sheet and say they don't really have the financial capacity to do any of the acquisitions of sufficient scale to do this. Yeah, I'm not saying Airea is going to end up like this, but it's a kind of cautionary tale of over-investing based on the idea that boom times are here to stay or around the corner. And yeah, you can be lumped with permanently slightly underproductive assets and a faltering share price. So hopefully this isn't going to happen to Airea, but yeah, I'm not sure I'm willing to take that bet anymore.
Yeah, I have a new way of thinking about Tandem. Tandem is the company that refuses either to die or to succeed. And it seems like there's lots of small caps seem to fit that description. They just roll along. It's not even clear why they're listed. You could argue Ariea is too small to justify a stock market listing as well. And Tandem and the likes of these companies with a market cap of about 10 or 11 million pounds. Ultimately, what is the point of a company having a 10 million pound market cap long term and keeping its listing? It doesn't make sense to me. And then often you have to check the remuneration report then and see, are the directors taking more out of the company than shareholders are getting in dividends? Often be the case. And yeah, for me, 10 million pound market cap is no longer interesting unless there's a clear plan to grow, because there's no point in having a 10 million pound company on the market indefinitely.
Those listing costs are just a permanent drag, aren't they? That's the reality. And doesn't look like the regulatory burden is going to reduce anytime soon.
I used to think that it was several £100,000 if you add in all the costs of being listed. I've seen some estimates that a listing could maybe cost closer to £100,000 or £150,000. Not sure what your estimates are on that, but with a £10 million market cap, I don't think it makes sense long term to keep a listing. Pay hundreds of thousands of pounds in cost on top.
The challenge, though, is if all these guys delist, what are you left with to invest in? It's the other one that struck me recently was, I think it was Loop Up. So this was another darling of the COVID era that's delisting, and it's delisting because it wants to raise money and it has commitments from some insiders, but they would end up having to take over the business. So they're having to delist in order to avoid the takeover code to be able to put money in to focus on the faster growing part of the business and survive through to the point of profitability. And it's a bit of a shame. I'm not sure Loop was particularly high up my investing watch list anyway, but it just feels a bit of a shame that you do have some companies that want to grow, but in the current market, they're delisting or being sold to private equity. I do agree, but I also wish that some of these companies did actually grow and keep their listing and that we can profit from some of that growth and recovery stories. It does amaze me that growth is mean reverting as well. Yes, there is an aspect of, do the management want it? Are they pursuing this? But even the fastest growing companies become pedestrian over time. It's just the way things go. You just hope they get to a sustainable market cap first.
Yeah, I think from £50 million and up, you've got a proper market cap for a listing.
At least the ones you guys are proposing are way above that. Yeah, Roland, do you want to take us away with your first choice to discuss today?
Yeah, absolutely. So this is Burberry, the luxury fashion brand. It's a FTSE 100 member, been listed on the London market, I think, for well over 20 years now, but been in business for well over 150 years. And I think luxury seems to be in the headlines a bit at the moment. There's been a bit of a slowdown in the wider market, and the company that owns Gucci issued a profit warning last week. And Burberry certainly has also issued a couple of profit warnings over the last 6 months or so. And the share price has come down by about 50% over the last year. So it's been quite a sharp derating for Burberry. And the stock, to my eye anyway, the stock looks unusually cheap at the moment, really cheaper than it's been in some ways since 2008, 2009. I think the question is whether there's any lasting change in the luxury market, because there's been this long-running story about demand growth, especially from China and the growing middle class there. But that seems to be changing slightly, maybe. China's developing its own luxury brands and maybe tastes are changing. The kind of context is changing a bit. So issued a couple of profit warnings, and perhaps you might say that there's scope for one more round of disappointment before things hit the bottom. But financially, it's sound, it has a valuable brand. I think the shares are now down to about 14 or 15 times forecast earnings and yielding about 4%. So it's unusual for this kind of luxury brand. If it is a truly valuable high margin luxury brand, it probably should be worth a bit more. And so I hold some Burberry and thinking about whether to buy some more or not at this level, because it's the share price, to put it in context, the shares first hit this level in about 2011. So it's been quite a roller coaster really the last decade, and this seems to be perhaps some kind of turning point that's still unfolding. I think, Graham, you own Burberry shares as well, don't you? What's been your view on developments recently and the story?
Yeah, I'm a long-term shareholder here, so I've held it through various price swings, including the COVID swing. This latest one is a little bit worse than that one. It's an immaculate company in terms of its financial performance. Returns are just beautiful. The quality metrics are amazing. Some people don't like investing in this type of fashion brand because they say it's difficult to predict fashion trends and that it could fall out of fashion. But I think the story with Burberry is, as you mentioned, it's been well over 100 years old, maybe 150 years old. I think that the company has always maintained a sense of its heritage. It's one of the few companies you'll find where the chief creative officer is one of the most important members of the C-suite. And they've had a new one since 2022. And I don't know anything about fashion, but it seems to me as if this guy, Daniel Lee, has an appreciation of the heritage of the company. Yeah, I think it's a brand that will stay powerful long term. So in that sense, I have, I guess you could say, faith in it. As a company, it should probably just merge, or it should probably get taken out by Louis Vuitton at some point. I've always said that it would make sense to be part of Louis Vuitton. or maybe someone else.
It's relatively unusual being a British luxury brand, isn't it? Most of the other big names are continental European. But as you say, they are focusing on the Britishness aspect. It's part of the strategy, isn't it, to not to try and dilute that away, but to emphasize it. I agree with you. I think the quality-wise and so on, it's very strong and has a lot of attractions. It's maybe the growth story in the near future, whether that's as it was thought originally or whether it's going to be a step backwards before taking a step forwards again. But I don't know if Mark, if you have a view on...
Yeah, I'm surprised you say the financials are impeccable here, because looking at the kind of long-term revenue, it seems to have barely grown in a period of low inflation at the start, but it could easily... I think 2023 was a relatively good year, and then it's forecast to decline slightly this year. And that could easily just be inflation in that year, plus the EPS as well. There's a bit of a short-term EPS decline, and it's... the 2025 forecast is below the level of 2018, for example. So I know you're a big fan of the return on equity here, and that you look at that sort of 25 to 30 level as being a sort of Goldilocks level, and it's supported by these luxury brands and things like that. But unless it can grow, that sort of return on equity, it doesn't go to shareholders. It's just a nice number in the annual report. Unless they can apply incremental capital to generate top line and then bottom line growth, then it's just a nice number. It's not a real thing. I take the point of these are desirable, like brands are desirable, but I look at something like Capri Holdings in the US. It was trading on a P of about kind of 7 or 8, and got a takeover offer back in August last year from Tapestry Holdings, and like a decent premium as well, sort of 50% premium mooted. But the deal hadn't closed yet because of competition concerns, and the price is now drifting. And you look at it, it's still in a P of 4, P of 10. So, and Capri is Michael Kors plus a few other luxury brands in there as well. And I'm a deep value investor. I'm not a luxury goods purchaser. Maybe you can give a relative balance of how good the brands are and what you should pay for your brands. But it looks to me that this isn't necessarily stand out at the moment for luxury goods manufacturers.
I think, yeah, it's a fair point. I think a couple of things. Looking back, I think revenue has only grown by an average of 3% a year over the last decade. Growth has been the problem, and it's been in a bit of a long-running turnaround position. I think it's maybe fair to say. And in terms of luxury positioning, I'm not a luxury goods shopper either, but from what I've been told and what I understand, it isn't for the very top tier of luxury. It's trying to get closer to that level, but it isn't quite at that level. That's a weakness, arguably, because conventional wisdom anyways, the higher up the pyramid you are, the more resilient demand is likely to be. But I think the quality is there in terms of the margins and the returns. But as you say, ultimately, if you're going around in circles and the business doesn't have a way to reinvest those returns productively, it's potentially a problem.
Yeah, I think that's a good point, that it's not at the very top tier of luxury. And that means it is vulnerable to the consumer, to consumer distress, the general consumer spending trends, which have been pretty difficult in recent years. And the COVID era was a disaster. And then the years since then have been very difficult. And I think Burberry has done okay in that context. I just point out as well, the gross margin is something like 70%. It should be more profitable than it is, in my opinion. And I think a lot of that is to do with the fact that it's standalone. Very few brands like this stay independent. So if somebody came in, they could rip out so many duplicated costs, I think massively improve the profitability. So I've always said it should get taken over, and I'm happy for it to be taken over anytime.
Do you think there's a trend here where kind of stuff like vintage so people are reselling luxury goods, whereas previously they have a handbag or kind of something they don't use anymore, and it sits in the cupboard, whereas now they think, I haven't used that for a while, I'm going to put it on vintage and get some cash for it. And do you think that's a factor for some of these luxury goods manufacturers? Or is it last season and nobody's ever going to sell on this product?
I don't know whether selling secondhand is likely to make people more or less likely to buy the new product again, whether they keep the old ones or get rid of them. I'm not sure if it will have a big impact on new sales, but I suppose it might cannibalize new sales. People are buying used instead of buying the new ones. And apparently the Chinese market, second-hand fashion is also becoming more of a trend, I think. And I think China too, like Burberry, about half of Burberry stores are in Asia Pacific, so presumably many of them are in China. And like with electric cars and cars generally, China's developing some powerful brands. And in luxury, I think they're developing more of their own native brands as well. So whether that will have an effect on the geographic picture or whether the top European brands will remain at a different level, I don't know. It's hard to have that kind of insight into the market unless you're, I think, involved maybe in the sector.
One thing I think it does have going for it is, on this slightly tangentially, is that it's just been range bound for 10 years. And if you buy around the £10 level, just above the £10 level, and you sell it when it goes above £20, you do pretty well. I think it got, on Stockopedia, it got a little bit lower than the current price in 2016. Was that the time everybody is worried about it becoming a chav brand, for want of a better phrase? I don't want to use that as a derogative term, but yeah, just that people were concerned that the buyer wasn't the typical luxury goods purchaser. Was that the 2016 time? That would potentially line up, I think, wouldn't it?
Yeah, or whether that was influenced by Brexit at all, I'm not sure.
Yes, potentially, yeah.
That's not helped luxury sales in the UK, I don't think, for any of the luxury companies.
And there's a VAT problem as well, isn't there? VAT problem as well.
There is now, yeah, I think. It's overseas buyers.
Go through that. They're closing the loophole where you can reclaim VAT. Is that right?
Yeah.
So as bus trips from Heathrow Airport to Bicester Village might be a thing of the past. Yeah. So if you are a fan of this sort of company, then now does look a reasonable time to buy. And I think I'd be trading the range rather than thinking this is a long-term buy and hold personally.
Yeah. I suppose one other point is there's been quite a bit of change in the C-suite. Graham mentioned the newish design, Daniel Lee, not new anymore. And prior to that, the chief executive. And so that whole new combination has only been going from memory a couple of years. So it's possible there's more to come. And the chief executive, he was previously in charge of Gianni Versace, and then prior to that, Alexander McQueen, and he was credited with some sort of growth and turnaround combination at each of those, I think. So he has a good record. He certainly has relevant experience in the sector. And from the current level, it seems like I think there should be an opportunity. But obviously that's an opinion, always subject to a later correction.
They always seem to hire amazing CEOs. I was a huge fan of, I don't know how to pronounce the name, Angela Ahrendts. From 2006 to 2014, she was brilliant. And now the latest CEO has the CV within fashion. Yeah, I have faith in the management team for what it's worth.
Have the new guys been putting their money where their mouth is? Because I'm just looking at Stockopedia, I'm seeing a lot of exercising options and selling to meet costs rather than any fresh capital coming in.
When you're talking about a FTSE 100 company, you're not expecting insider buying, really. At least I don't.
No, I don't see it as a big deal with large companies. It's nice, but it's not realistic. Whatever you think of it, I suppose it's not really a realistic thing to expect on a large scale. Or at least that's my experience. I think the smaller you go, it becomes more important to me anyway.
Great. Should we move on to the next FTSE 100 behemoth and staying with the fashion sector, but a slightly lower, not a lower quality company, if anything, a higher quality company, but a lower price point of a product.
Yes, I've been a long-term shareholder in Next and in Burberry. I'll hold them both for quite a long time. I suppose it was my good friend Paul Scott who explained the attractions of Next to me in the first place. And I'm always amazed by the reports that they publish. They're so clear. It's really taking a lesson in how to write clearly when you read these Next reports. I would say it's almost up there with Warren Buffett levels of clarity and high quality information. It's only in the past week Next has published their results. The results are not amazing. They're fine. Group profit before tax up 5% to £918 million. They have a tendency to underpromise and overdeliver. So generally, you find that EPS forecasts go up consistently during a year. So they give themselves lots of scope. There's just so much discipline in terms of margins and if they're going to do a buyback, how many shares they're going to buy back. I don't really care about dividends too much, but they'll pay a dividend when they can afford it, which is pretty much always. And yeah, so in their latest annual report, they provide a sort of a history of the company, which is quite rare. They lay out everything they've achieved over the last 25 years or more. When they explain the dynamics in retailing, they explain how they succeeded over the years. They say that things were very simple up until 2017. things became a lot more complicated after that, with online retailing cannibalizing them, and including their own online retailing cannibalizing their stores. So since then, it's been more difficult. Earnings per share has not been growing that much, but with the help of share buybacks, which some people would say is artificial, that is how they have achieved earnings per share growth. In the last few years, what I've been really excited by is their M&A strategy. Essentially, if you like the sort of small brands, just to throw out a name, Jules, if you like these small brands, you can own them through Next. Kath Kidston would be another, Fat Face is another. And again, going back to their financial discipline, Next will wait until these companies basically go into administration or have some other terrible problem and pick them up at a decent price. Then they can plug these brands into their infrastructure, into their platform. So they have this, they call it total platform. It includes a whole set of services, all to do with running a retail operation. And I suppose their idea was that this platform could be sold as a product to other brands, and the other brands would focus on their product and their brand, and Next would take care of all the logistics. But what they found is actually the way they've benefited most from this platform is by buying up their failed competitors, if you like, or other brands that have fallen on hard times, and simply plugging them into the platform. But they still view it as a client and service relationship. So the platform is providing a service to the brand, and they think about it that way. They even say in their report, we do not want to become a corporate blob. We have well-defined services that we provide to brands through our infrastructure, and that's a well-defined thing that they do. I don't want this to go on too long, but I should probably mention the guidance for this year. So they're guiding for full price sales this year to go up by 2.5%. As I said, the growth numbers here are not spectacular by any means, but that's what they're guiding for. Total group sales expected to grow by 6%, and they're guiding for full year pre-tax profit to increase by 4.6% to £960 million. And the market cap here is £11.7 billion. Not too expensive in terms of the earnings multiple. High quality company, amazing management. They're at a scale where they can gobble up other companies and just digest them. And I think it's a great story.
I do love the quality of the reporting here, and they really are best in class for just the information they reveal to shareholders and how they present it, and how timely their reporting as well is. It really shows that they've got these great systems behind the scenes. But I want to turn the flip side on that and say, what is your edge here? This is a really big company. There's lots of analysts that follow it. Everybody knows it's got a great kind of long-term record, and all the information is presented to you in an easy format. What analytical or behavioral edge do you think you can get on a company this size?
Do you own shares in this round?
No, I don't. I have owned Next in the past. I bought the shares in 2017, funnily enough, and at an average price of about £40. And I sold them since then, thinking that I'd done well. But obviously, I would have been cleverer not to have sold them, I think. And I'd hope if I was in that situation now, I'd have kept hold of them. But I think the edge, as you say, Mark, there's no great secret about Next, except perhaps I think the edge would be that you're trying to find a good entry point and then being patient enough to allow their model to continue to deliver results. Because looking at the last 10 years, revenue and operating profit have only grown by an average of about 3% a year. And the guidance that Graham just mentioned is not a million miles from that still. At face value, it looks like a mature, slow-growing business with maybe not so many obvious opportunities for growth, but it's very well run, and the model seems to continue, still seems to be working. So I suppose the edge would possibly just be patience and good timing maybe on the way in. I don't know if you agree, Graham.
Yeah, I'm from the Terry Smith school, which says the good companies are hiding in plain sight. You just have to pick them up. Many people will know that they're good companies, but they won't own them, or they won't own enough of them. And it may not produce the same returns you'd get on AIM with a successful small cap investment. But I do believe you can beat, say, the FTSE 100 index by buying good FTSE 100 companies and just holding them for years.
Yeah, and just to expand on that, I suppose, actually, another experienced investor said to me once, you're not going to find the next Amazon on AIM. And some of these companies are this big because they are perhaps very good businesses. Next is still generating a 30% return on capital. The shareholder returns are carefully engineered or structured, if you like, to boost shareholder returns. And I think another thing about this business that's very well managed is the finance side of things. As far as I know, I've never heard of any problems, kind of regulatory problems with Next's finance operation. I may be wrong, but certainly it's generated consistently something like 20% of operating profit, give or take. And so I think that's really the icing on the cake, maybe in terms of profitability. It would still be a decent business without it. But when you add that in as well, the profit from finance, which again is a nice big scaled established operation in the UK at any rate, it's just another piece of the puzzle that just steadily delivers over time.
Yeah, I do agree with that, but I think for me, Ron, you hit the nail on the head with the entry point. The aspect of actually the key to companies like this is to buy well. And I'm just not convinced that the current price is a good purchase point. And I take the point that they tend to underpromise and overdeliver, and there may be some more kind of momentum in these results. But just taking the price for most of last year was around the kind of £70 mark, and it's currently low £90 mark, so the price has gone up by 30 something percent. But the reality is that the EPS forecasts have gone up by somewhere between about 2 and 4%, depending on where you are in the year. So this has got somewhere about kind of 25% more expensive in the last 6 months to a year. That just doesn't seem like a great entry point to me. I look at the long-term chart and I see that it goes through these kind of periodic kind of panics. It was up at £8 in the end of 2021, and it was back down to £80 and £45 by the middle of October 2022. So yeah, I do like it as a company, but I'd be much more tempted to wait for one of these they seem to happen every 18 months to 3 years. There's some kind of market panic about Next and it sells off. And what do you think of that as a strategy rather than buying today at £90 something?
There will probably be some scary reason that it's at £50 next time. But absolutely, I'd rather buy it for £50 than £90. I do think a P multiple of 10-ish tends to represent great value for Next shares. That's probably around where I've been buying it. So yeah, obviously at 15 times, it's a more optimistic share price. And yeah, I probably personally would be buying it more around 10 to 12 times.
Does that not make the current price a sell? Because I'm looking at the PE range on Stockopedia with the kind of high and low. And apart from 2021, which is the kind of COVID year, it tends to peak around the sort of 14, 15 level. And as you say, trough around the 10 times level. Does that not make it a sell?
Well, except that I don't sell it. I just hold it. And I get the dividends. And maybe one of these days, it won't go back to 10 times. That's always the risk, that it stopped oscillation at some point. But yeah, certainly, if you are interested in it, 10 to 12 is where I was buying it probably historically. Hopefully you'll get that buying opportunity in the future, Mark.
I'll keep an eye out for it because it is a great company. It is a great company. Yeah, let's move into the small cap world. So I'm going to make a pitch for what I think is probably the cheapest UK trading business at the moment. So there's some resource stocks and things like that look cheaper. And it's a company called NWOR. So it is the brainchild of a guy called David Montgomery, who is executive chair, I think. And he used to be editor or used to be involved with Reach when it's Trinity Mirror back in the day. And he left, I think it's even like 2003, 2006, that kind of time. Then he built up a company called Local World, where he was buying up local media publications. And I think in maybe around the mid 2010s, so around 2016 time, he sold it to Reach for a nice profit. And fast forward a couple of years and he started his next venture, which is National World. And hey presto, it's rolling up regional newspaper titles. So it started off buying what used to be the old Johnston Press assets. And they just turn these into cash. They just turn these businesses into cash cows. So they often pay back out of internally generated cash flow within a couple of years. And nobody's heard of National World. There is actually a website they started, which is newsnationalworld.com. But the reality is people have heard of the Scotsman, the Yorkshire Post, the Sheffield Star, and the latest acquisition was some sort of Midlands titles that I can't remember off the top of my head. But that's basically the model. And they had results recently and they beat expectations. So they were a company that had sold down by the end of last year down to about sort of 13, 14p. And then in January, they said, we're going to trade ahead of expectations. The share price went up a bit and then it gradually came all the way down again. And then the results came out last week, I believe, and they were ahead of expectations again on an adjusted EBITDA level. And I think you guys are probably going to pick me up on this one. But you look at the adjusted earnings here and they're forecast to do, I think the 2.5p that was forecast in Stockopedia is actually came in at 2.8. And then the brokers have graded the forward year in response to these results from 3p to 3.1p EPS. So you're paying less than a 5 times PE for adjusted earnings for this company. And on top of that, they've got about just short of £11 million in cash. And unlike a lot of companies that are just sitting on this sort of cash, they're going to use it. They are in the process always of looking for media assets they can purchase, put their own advertising stack in the background, train journalists in being digital first, putting a digital first strategy. And despite a pretty weak advertising market, this company has been throwing off cash. So you then adjust that. If you adjust that PE ratio for the fact they've got about a third of the market cap in cash, maybe a third to a quarter, you suddenly end up with a PE of less than 4, and it just looks too cheap. Now, people say, oh, it's a legacy business, it's got problems, and you're probably thinking of Reach at this point, which has a massive pension deficit, phone hacking provisions, a bit of net debt, and various other problems. Whereas NWOR doesn't have any of that because they have been buying up companies without the pension liabilities, without legacy issues. Their numbers are pretty clean. They forecast this year they're going to do about 100 million in revenue and that their EBITDA margin is going to be improved. So I reckon they'll do about 11 million EBITDA this coming year, which means they're on about 2.8 times EV to EBITDA. So pretty cheap. But more importantly, if you run those numbers and treat Reach's pension recovery payments and provisions, things like that, as debt, you end up with a rating that's twice this value. Yeah, if you think NWOR is fairly valued at sort of 2.8 times EV to EBITDA, then you should probably think the value in the equity in Reach is worthless. Maybe you guys can come and argue that is the case. I'll turn it over to you guys for the bear case or your thoughts. Roland,
yes, so I suppose obviously there's no great secret that newspapers and especially smaller regional newspapers are struggling to make money and to maintain worthwhile print circulation. So I can totally see the logic of putting in place a common technology platform and all the rest of it. I think some of the titles are quite good. I suppose I'm a little bit cynical about some of the business model. I think a lot of it is about really quite harsh cost cutting and really sweating the assets, and maybe not. Maybe the papers, you might argue, possibly are not as distinctive and interesting to read as they were, but fair enough. It's working. I can see that it could work, and David Montgomery does have a long record in the UK press business. I thought last year's results had a lot of adjusting items and other costs in, and when you looked at some of them, under my sort of estimate of underlying free cash flow for the year, including various costs relating to acquisitions, but not including the acquisition, I reckon the business only really generated about 1 million or just over 1 million of actual surplus cash from it. And I was a bit struck by the amount spent on acquisitions that didn't go ahead. There was 1.2 million of expenses about attempted acquisitions and then another 300k on aborted transactions. So they're obviously out there, very active, but not all of these deals are maybe falling into place. But I think it's not a business you'd put on a high multiple, but I can see your point that it probably is cheap or could well be cheap at the moment. And I think they're looking at 100 million of revenue and an improved EBITDA margin this year is their guidance, I think, from the company. So that I can see why you might be interested in a possible trade here is how I might be looking at it.
Yeah, I think that on the trade point that I'm pretty sure there's some kind of overhang here. Now, one thought is it's Downing. So Downing Microcap Trust is being wound down. So that represents some kind of overhang, but isn't really their style to sell in the market. This company has a following from some of the other strategic microcap investors, such as Wood Strategic, I believe, and I remember who else owns it in terms of this sort of fairly active fund. So I think despite the obviously overhang from Downing, or my understanding is they're not actively selling in the market at the moment, but that could be weighing on some shareholders' minds. So I think there's another active seller. I don't know who it is, but I think that has depressed the price unusually. It looks to me like some kind of forced selling. Yeah, I think you're right. I think there is a trade aspect to this, but I do think there is some long-term future here. They are growing, they are doing well. And yes, they are cost cutting. And that is one of the big restructurings, one of the big adjusted lines that seems to be a bit more part of their normal business. However, for my sins, I support Sheffield Wednesday Football Club, who are going through some difficult times. And the Sheffield Star, I doubt they pay them very much, but they employ real journalists who go to press conferences and report on the ground about the football club. So if I'm going to visit a national world site, it's because I'm following the football news for my particular club. And I compared some of the reach sites for this sort of news. They seem a cut above still. Maybe they will start cutting these journalists as well, and it's so cutthroat. That isn't the case. But that's my personal experience here, is that they're potentially not just creating clickbait headlines. They are actually reporting news.
That is an area they're still creating value for local readership, which is what they say the core model really is. That's yeah, I suppose that's fair enough. One thing that interests me, I think that's maybe something that's not unique to this business, is I noticed that revenue from print publishing is still around 3/4 of the group revenue, and then digital publishing revenue is most of the rest, and then there's some they get from grants and events. It's hard to compare exact numbers because they specify a monthly print circulation and then monthly page views for their websites. So they don't seem to, in the report anyway, in these results, they didn't seem to give the number of users per month, which would have been maybe more of a comparison to monthly print circulation. So yeah, what I'm getting at is it's not that easy to compare the value of print users and digital users, how much revenue and maybe how much profit they generate. But that's not unique to this business. I think a lot of media businesses are facing that same thing, that digital views might be relatively easy to get, but the advertising doesn't always pay as well.
That I guess is one thing that worries me, is that I've visited the Sheffield Star website a few times and never clicked on one of the adverts. But then have I ever clicked on an advert willingly for anything online? I don't think so. What about you, Graham? Is this a concern for you?
Can I change topic slightly?
Yeah.
They're not really telling us like for like numbers.
Yes, there's no organic numbers in there. It's all with acquisitions.
But this seems like a glaring omission, if you don't mind me saying so. This is in the 2023 results. They say 7 acquisitions completed in the period, contributing revenues of £10.5 million and adjusted EBITDA of £1.7 million. So then it's left to us to go and subtract those numbers from the 2023 results to see what would have happened without those 7 acquisitions. Total revenue grew by £4 million and EBITDA fell slightly, including the effect of the acquisitions. So I'm not loving the presentation here where we have to
I think that's a fair point. And I think they should also tell you with those adjustments, are they ongoing? Is it one-off or is it ongoing? Because for me, there's a big difference between you make a load of people redundant on an acquisition, or you rationalize property costs on an acquisition and it's done. And we're going to do the same. We're going to take the same cost year after year, at which point that shouldn't be below the line for me.
Oh, absolutely. And so we're left with revenue without the acquisitions would have been £78 million, which is a fall from 84. And adjusted EBITDA without the acquisitions would have been about £8 million, down from 9.7. I'm not clear if they made any acquisitions during 2022, which would also have boosted 2023 results because you would have had a full year of ownership as well in 2023. So I'm a bit suspicious of this on that basis.
Yeah, actually, if I can, just extending on what you're saying, Graham, looking at the circulation and the digital statistics, although print advertising revenue only fell by 1% last year, their print circulation was down by about 10%. And then in digital, they do give a number. Excluding acquisitions, digital page views only rose by 8%, but digital advertising revenue They don't give that, I don't think, excluding acquisitions. But yeah, so print circulation was down 10%, and organic digital page views, if there is such a concept, only rose by 8%. The underlying picture is that they possibly need to keep rolling up titles to keep the show on the road, or at least profitability is going to maybe tough to maintain if they can't continue to add volume, perhaps, is maybe more of a fair.
I think there's a cyclical aspect to this as well, in terms of you look at something like a Digital Box that reported today, which is pure digital page views, their own TV guide and the MASH and a few other kind of lower tier websites. And they have seen, just digital advertising rates really be pretty low and be a pretty challenging market backdrop for that. So I guess it depends whether you foresee a cyclical upturn or certainly I think both businesses are battling a cyclical downturn in 2023, and nobody knows when this will turn. But unless you think this is a permanent structural decline, I think there should be a kind of tailwind from the recovery in this area, a bit like retail. A lot of retailers are struggling at the moment because there's a cyclical downturn of consumer demand. And that's probably the $1 million question. When do you assume consumer demand is going to return, and what impact will that have on companies' profitability?
I'm also looking at some of their commentary on competition, and it seems as if they're just saying that they can't compete. They say the sector is still experiencing unfair competition from the social media platforms. And they're talking about the media bill redressing the balance by assisting publishers. They're also talking about unfair competition from the BBC. And they have a negative word to say about online streamers that disseminate entertainment information and distraction products for every device. They're really struggling with all this competition.
It is a bit of a whinge, isn't it? It's a bit of it's one of these, somebody who's got to get their opinion out there about things.
It's like the old man waving his newspaper at the moon or whatever. It's They want people to stop watching Twitch and go and read The Scotsman instead.
But again, what I take away from this on the other end is I don't think the BBC is going to get more competitive. If they're doing this well in such a tough competitive environment, then it seems to me like things can't get any worse. I take your point. It does come across a bit of a whinge, doesn't it?
It does a bit, yeah. They're saying too, they're interesting to give an idea of scale. They say BBC had 3.1 billion page views for BBC News in January, and National World say their monthly page views were 139 million last year. So very small compared to the footprint that the BBC has in terms of page views. But it does seem to be whinging a bit, which I find slightly discouraging sometimes, that kind of approach, really.
I think what we can all take away from this discussion is we should be shorting Reach.
At least you have cash here. So that is a big attracting, a big advantage,
Hilariously, they did try to buy Reach, which was what happened last year. Well, which is properly had the financing in place for it. I guess this David Montgomery guy has good connections in the industry.
He previously sold a big package of papers to Reach, didn't he?
That was the local world that he sold to them.
So he knows for the assets,
yes.
I guess.
I did wonder whether it was a sort of fishing trip to try and make Reach by National World to get him to go away. The other thing they were looking at, and potentially some aborted costs, were they're looking at buying the Telegraph. And again, you look at the comparative scale of the businesses, and but there's no lack of ambition here from this guy. If this doesn't meet Graham's current 50 million market cap requirement, but if it's management ambition that makes the difference, then this certainly isn't one to sit there on a low market cap and just pay the dividends. This wants to go somewhere. Whether they can deliver that is to be seen.
Point is that they're using their listing, which is they want to be more than what they are now. So absolutely.
Yeah, fair point.
Seems to me like we've covered a fair amount today. Good to see you again. Good to have a fun chat. And thanks everybody for listening, and we'll catch you next time.
Thank you.
Yeah, thank you.
Well, that's it for this time. Thank you for listening to the Investors Roundtable podcast. Please and share if you enjoyed this episode. It really does help us out. If you have any questions for Roundtable, please leave them in the comments section below, and we'll do our best to answer them in the next Roundtable podcast. Once again, thanks for listening, and until next time, happy investing and goodbye.